Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we're going to be analyzing Deere stock. This one came in by request. If you have a stock you would like me to take a look at, just drop it in the comments section, and I will get it on my list. And I will eventually post a free YouTube video if it's in the S&P 500. And if it's not in the S&P 500, I post those analyses over on Patreon for $5 a month. You can join there. And if you join there, you can get a big discount to my full Cyclical Investors Club service where I have all the spreadsheets, chat rooms, lots of articles about investing. You can contact me whenever you want. So lots of benefits there, and that's located over on Seeking Alpha, and I'll have those links in the description. As always, this is not investment advice. This is just how I analyze stocks. And today, when we look at Deere, we're going to see probably my more unique analysis for a deep cyclical stock. This is a style of analysis I developed in 2015, so I've been using it about 8 years now, and it's worked really well for me over the years. I have never bought Deere. It hasn't quite fallen far enough for me to buy during this time. But the first thing I always like to check is the historical earnings cyclicality. And as we can see, usually 50% is kind of the threshold that I use. This is just these 3 years during the industrial recession where earnings are falling. During a down cycle, that's not quite 50%. 2008 had a single steep year that was 40% with adjusted earnings, but if we use basic earnings, it was more than 50%, and the stock fell quite a lot. So I treat this one as a deep cyclical stock. And that means that other than looking at the peak earnings going into a down cycle, I don't really use earnings other to establish that it's a high quality business. So we see higher earnings peaks each time, even before COVID. We see lower earnings troughs each cycle. So that's, and I have data going back to 1973, not on FastGraphs, but on my chart. So these guys have been around for more than 50 years as a publicly traded company, and there's lots of data. They've always recovered from their down cycles in a relatively timely manner. So if you can buy them during a down cycle, you can do really well with the stock. You can also suffer quite a lot if you buy near the peak of the cycle. So my strategy with these stocks is I try to buy near the bottom or at a predetermined point off the high, and then I hold them until they reach a new high, and then I usually sell them because eventually they'll have another down cycle, and then maybe I can buy them in another down cycle again if they get cheap enough. A lot of people know about Deere. A lot of people like it. There's a lot more buy and hold investors in the stock right now, so it might not fall as much as it has in the past. But it's one of those things where I just follow enough stocks, and I can't make the stocks get to the price I would be willing to pay. I just have to wait and see if that's what the market will give me. So what I do is I look back in the past to see what the market has done in the past. And I just wrote an article on Deere last month, or earlier this month, for Seeking Alpha. And this is a table of their previous price declines during downturns. So this is how far they fell off their peak. This one is 1973 was 57%, 81, 55%, 90, 50%, 1998, 54%. These are the start of the declines. 2008, 70%. 2018, a little smaller down cycle because we had all the stimulus from COVID, and that was 38%. And then we don't know how far 2023 is going to be yet. So usually what I do, once I establish it's a high quality business, if it recovers in a reasonable amount of time, usually don't get too much argument about that with Deere, so I don't go into it too much. I just look and say, okay, well, what has the market been willing to give us in the past? And usually, if it's a recession, they are willing to, the market gives about 50%. Can be deeper as 70%. This particular down cycle, I would be willing to go ahead and, just because Deere is so high quality, I'd be willing to go ahead and buy after a 50% decline. However, because of this huge upcycle in earnings where they tripled in just 4 years, I think the 70% decline is at least on the table. So investors who are buying this on the way down should at least be mentally prepared that that's something that can happen. That's kind of normal, I would say. It won't feel normal if it happens to you after you buy the stock, but you don't want to panic and sell at the bottom. So that would be like the worst thing I think that you can do. If we compare the peak PE this time, it was about 21. This can be useful to compare to other peak PEs. So if you go to the past down cycle, the peak PE was 21, and this was a 70% decline. So it's definitely in the going into the recession. It's definitely potential. So for me, I take 1% weighted positions. I would look to take a 1% weighted position at about 50% off the high. And then I would expect the stock to recover probably within 5 years. Most of these recoveries were within 5 years. 81 took longer, and that was a particularly bad, you think of like the farm crisis and everything. So it can take longer. I actually ran the stats on this for this article so we can look at it. So that 81 decline, this is if you bought after a 50% decline. It still would have produced a 17% CAGR, but it would have underperformed the S&P 500 during that recovery. During the rest of these recoveries, it would have produced excellent returns, and it also would have outperformed the S&P 500. So that 50% level is a pretty good spot to aim. I think there's a decent chance, a pretty good chance that it could hit, even though it's still popular, mostly because of this huge upcycle. And again, I think the one thing I would really warn people of is this 11 PE that you see here. Imagine if earnings were half what they are now, that would be a 22 PE. So it's the mistake you don't want to make is to buy this thinking it's an 11 PE and then be completely surprised when the stock falls 50% from here and then panic and sell down here at the bottom. That's the big mistake most people are gonna probably make. So I would say don't do that. If a person did buy it and really loves the stock, if you're not going to play these cycles, you just have to commit to the long term. It does have a good long-term track record. So if you would have bought at the peak in 2008 and you held until pre-COVID, you wouldn't have done well, but you would have gotten a 6% return just by being patient rather than losing 50% or 70% or whatever if you panicked and sold at the bottom. So the price peaked out at 400, 50% is 200. That would probably be when I would step in and take a position. And then I would be willing to hold that. I would be prepared and expecting to hold that for maybe like up to 5 years. But if it recovers, you get a double. So you get very good returns. Excuse me, you get very good returns even if you have to wait a while, if you buy at the right price. Okay, if you like the video, hit the subscribe button. I'll see you guys in the next video.